morning, everybody. Welcome to today's 1 million by 1 million online rendezvous. We are broadcasting live on LinkedIn, Facebook, and Twitter. Great to see you. Thank you for being here. 1 million by 1 million, as you know, is the first and only global virtual accelerator in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. And in support of that mission, we offer you many touch points to interact with us. Our flagship events, weekly events, is our mentoring roundtables every week. So if you go to 1mby1m.com, our website, you will find free public roundtables. And that's the best place through which you can come and share your business, your projects with us, and we'll be happy to brainstorm and guide you through your strategic issues. So I'll come back to that in more detail a bit later. In these sessions, we started doing these sessions, when was that? I think it was back in September, maybe, when LinkedIn opened up this LinkedIn Live technology. And we've been, we've done a lot of sessions since. And what we've settled down on is answering questions. Basically, we take frequently asked questions that come up a lot of times in our different touch points, different modes of communication with you, and we take a selection of those and answer those questions. And therefore, you are very welcome to ask questions in the public chat. You should go ahead and ask questions in the comments. I will definitely answer those questions, and if it's a longer answer, then I'll pick it up and answer it next time. So by all means, make it as interactive as possible so that we can have a chance to dialogue and address what's on your mind. Okay, so we'll go to our first question today. And this is kind of a continuation of the topic of platform as a service that we have been discussing over the last two sessions. So the question is, how does PaaS impact the stock prices of SaaS companies? I assume you've been reading my commentary on platform as a service. I've been writing extensively. So there was a piece that I wrote called SaaS Companies Who Have an Unprecedented Opportunity. In that, I started highlighting the massive momentum in cloud stocks exactly 2 years back. Then I wrote a piece called Cloud Stocks, SaaS Companies Need a PaaS Strategy. And then I also wrote Cloud Stocks Calling All PaaS Leaders. I pointed out in those how PaaS is a key strategic tool in building leverage for SaaS companies. At the end of 2019, I published Cloud Stocks Top 20 for 2020, with a summary of which SaaS companies are succeeding on the basis of a strong PaaS strategy. Salesforce.com, Microsoft, Amazon, Atlassian, ServiceNow, all are featured on that list. Recently, I also published a thorough review of Atlassian's excellent PaaS strategy. We discussed it I think it was last session or the previous session. And the relevant post on that, if you want to go check that out on our blog, is Cloud Stocks Atlassian has a strong start in 2020. Atlassian is knocking the ball out of the park with the PaaS strategy. Their marketplace has reached massive scale, recently surpassing $1 billion in lifetime sales. It is now one of the largest enterprise software marketplaces alongside AWS and Salesforce. To boost its efforts, Atlassian in December announced Forge, its new cloud app development platform. Forge is expected to increase the number of third-party cloud apps available on the marketplace, creating more value for cloud customers. And there are currently over 4,000 apps available on the marketplace. In addition, developers have built 28,000 apps for their in-house teams. Across Jira and Confluence, over 60% of customer instances use at least one marketplace app. This is Atlassian, and it's just really, as I said, they're knocking the ball out of the park. Let's analyze the PaaS opportunity with some examples. The beauty of the model that Salesforce.com introduced with their PaaS and App Exchange marketplace lies in the leveraged multiplier effect of developers writing apps on their platform, selling to their customers through the marketplace and paying platform or marketplace fees of almost 30%. The model is no different from Apple's App Store. Some numbers. Let us say a SaaS platform vendor succeeds in facilitating 100 small companies to achieve $10 million in ARR each. That would add up to $1 billion ARR cumulative. 30% of this, or 300 million ARR, comes back to the company as platform fees. This conceivably amounts to $3 billion in market cap enhancement for the PaaS vendor. If they can generate $300 million in ARR, that definitely, given today's SaaS multiples, it would amount to a $3 billion market cap enhancement. Now, if you look under the hood, Salesforce.com's 160 billion market cap attributes a large component to this type of revenue. Atlassian is trying to take a page out of this playbook. If the company can make its 36 billion market cap amplify by adding several billions through entrepreneurs developing on their PaaS, the stock goes to the stratosphere. ServiceNow is also trying to do a comprehensive PaaS strategy. However, it is emphasizing large system integrators, not smaller startups. The business model, therefore, is somewhat different. I would have preferred to also see ServiceNow preserve a strong commitment to the startup ecosystem, not just on large system integrators. Let us see if that happens in the next rev of their strategy. Overall, I'm bullish on those PaaS players who are building strong developer ecosystems and facilitating the small business sector decisively. Companies like Shopify have such initiatives in the e-commerce platform space. Competitors BigCommerce and Wix would do well to emulate. Intuit, with millions of customers, should be able to amplify its 75 billion market cap greatly by emphasizing a PaaS strategy. Workday and ServiceNow should as well. Splunk, Alteryx, Twilio, MongoDB are all platform vendors well positioned to do great PaaS strategies. Zendesk, HubSpot, Bill.com, and several others need to consider how to play in this space. Cloud stock analysts need to start analyzing what percentage of the revenue and market cap of the stocks they cover are based on PaaS commissions. It would give them substantial insights into the long-term prospects of the equities under consideration. And CFOs of SaaS companies need to start reporting PaaS revenues separately and provide guidance on when such revenue may hit the exponential growth curve. In summary, PaaS today is poorly understood, inadequately reported, badly strategized, and woefully underemphasized. This needs to change. Okay, let's do another question. And now I'm going to switch to some questions that we see all the time. You know, our platform has a big emphasis on bootstrapping. So we get all kinds of bootstrapping related questions. So I've picked a few of those for today's discussion. So the next one we're going to do is, what are some of the best bootstrapping techniques? I have written extensively on this topic. Raising funding for startups is a low probability game. No matter where you're raising funds, it's a low probability game. Fewer than 1% who try actually succeed. In Silicon Valley, it's a low probability game. Outside the valley, the startup ecosystems are less mature. Some have started maturing, and the probability gets lower in the immature ecosystems. The bar to raise seed funding is getting higher and higher. Seed investors are mostly operating as growth investors, expecting that the entrepreneur will somehow manage to bridge the gap and bring a concept to realization. In fact, what these investors really want is to invest in businesses that already have traction, not just validation. They want to see product market fit. They want to see, customers buying. In short, they want to come to the rescue of victory. As an entrepreneur, how do you go from concept to traction? How do you bridge the seed capital gap? What do you do if you're full of dreams but stuck in the gap between concept and seed? Offering a service is one of the best ways to bootstrap. This remains a controversial point of view. Most industry observers take the position that companies get distracted if they try to bootstrap a product with a service. But from where I sit, given what I've seen, bootstrapping products with services is a tried and true method. Let's look at a few examples. Agile One, a company that provides cloud-based predictive customer analytics, was founded by Omer Artun in 2006. Initially, the company relied entirely on services to get close to customers, understand and address their problems, and in the process, generate revenues. Today, Agile One's product is a software service platform. Much of what the company learned about its customers in the services mode has been developed into its product. Although a good percentage of revenue still comes from services, and that's okay. Omer bootstrapped his company from no revenue or employees to about 45 employees and over $15 million in revenue by the time Agile One partnered with Sequoia Capital in 2011. Silicon Valley's top venture firm made a sizable investment at a high valuation in a company that was bootstrapped using services. Andy Chow, a PhD student at Stanford, also bootstrapped his company, Coverity, using services. Andy's research was financed by DARPA at the university. The technology allows automated cleaning up of large code bases and was licensed back to the company by Stanford. Andy recounts his funding story. We talked to all of the VCs and told them that if they wanted to invest in us, we would only consider certain types of deals. We presented them with our range of acceptable terms and indicated that if we did not receive offers in those ranges, we were content to continue bootstrapping the company as we had a solid clientele. We were in a sweet position where we had revenues and did not need to receive additional investment to succeed. As a result, we got a good deal from Benchmark Capital. They invested $22.3 million in us in 2007. Can you imagine the first round of financing, Series A, $22.3 million, where the entrepreneur calls the shot on the terms? Isn't that wonderful? In our incubation methodology at 1 million by 1 million, we actively encourage entrepreneurs to engage in services businesses. In particular, we encourage them to immerse themselves with customers, learn their problems, and do some services projects that not only generate cash, but also generate customer intimacy and trust. Through these kinds of dialogues, entrepreneurs diagnose real pain points in customers and end up building products that customers are willing to pay for. Consider one example from our portfolio. Rails Factory, a consulting and app development company that provides solutions for web applications framework Ruby on Rails, was co-founded by Senthil Nayagam and Dinesh Kumar in 2006. Rails Factory provides numerous services, primarily focusing on app development on the Ruby platform. Senthil and Dinesh bootstrapped Rails Factory themselves, starting with about $1,200 of seed money. When they needed to, they each utilized other personal resources. Senthil reached into his savings and Dinesh turned to his parents. But they started generating revenues fast. That's important, that's key. Thanks to the services they offered, they were generating revenues by their second month. And they've been growing since. To date, Rails Factory has executed over 100 projects and has worked with clients in the US, Canada, India, Australia, Singapore, and the UK. Their services revenues have crossed a couple of $1 million, and the company has recently built a product that they have started validating with those 100 services customers. The productized offering enables them to offer a support package to the small to medium enterprise segment based on packs of trouble tickets. Each of these companies bootstrap to profitability via services. Not only is this a viable method of getting your startup off the ground, it's a proven method of reaching profitability as well. In some cases, it can take you to the enviable position of having VCs like Sequoia or Benchmark knock on your door. In other cases, you could even have investment bankers come calling, wanting to take you public, and a whole slew of late-stage investors wanting to shower you with funds. All those are desirable outcomes. All right, we'll do another question. I already gave you a bunch of examples, but the question is, what are some great bootstrapping examples? So we'll do more examples. Examples are always good. The entire 1 million by 1 million program is designed on the basis of case studies. We have over 1,000 case studies, and these are really powerful examples of what strategies people have followed, how they have navigated, how they've put one foot before the other. So, for those of you who are rushing to raise venture capital with a deck or slides or just a minimum viable product, let me offer you a challenge. How can you get to a $20 million pre-money valuation in Series A, raise $5 million, and keep control of 80% of the equity? That's what Christian Chabot did, founder of Tableau Software. And he can teach you from his real-life experience. Chabot, needless to say, did so by bootstrapping the early stages of his company, validating the customer need, building a great product in the domain of analytics and visualization, and generating serious revenue and OEM partnerships before going out to raise any venture financing at all. So where did he get the money to bootstrap Tableau? Well, he started a prior company, Beeline Software, also bootstrapped, and sold it to Vicinity for a nice upside. He then used that capital to launch Tableau. Chabot says he started Beeline with the plan to flip the company for a quick return, but then started Tableau with the intention of building a large company. And he did. For that, he raised 5 million Series A and a 10 million Series B from Silicon Valley venture firm New Enterprise Associates. The case study is on our blog. You can read it there in more detail, but it's a great example, a great case study. Greg Gianforte, CEO of Right Now Technologies, can also teach you a thing or two about the topic of valuation and ownership. Gianforte is a huge proponent of bootstrapping and a master of cold calling to find customers even before writing a line of code. Gianforte is also a serial entrepreneur who bootstrapped a smaller company earlier, sold it, and then used the cash to bootstrap his second, a much larger CRM company that went public and has since been bought by Oracle for $1.3 billion. He says, and I quote, "I had no trouble finding companies that did a lousy job of serving customers over the internet. Most had a website and a button that said, 'Click here for customer service.'" Gianforte recalls, "Back in 1998, I could click on that and find a phone number. Who goes to a web page hoping to dial a phone? Nobody. But companies did not know any other way to work. All I had to do was convince those employees that there was a better way of doing business." I'm convinced he did. Quote, "We let companies try it for a while to see if they liked it, because in order for us to do business, they had to recognize the value," Gianforte said. "Typically, we eliminated 50% to 70% of the emails coming into the business. When we came a month later to shut down the trial application, the companies would say, 'No, where do we sign?' That is how the business was built." In 1999, that was the first year of doing business. Right Now did about 444,000 of business the first quarter. The second quarter, they did 697,000. By the third quarter, things had really picked up. The company did 1.5 million in that quarter and 3.3 million in the fourth quarter. What I like to emphasize is that we doubled revenue and the number of employees every 90 days for 3 years without outside funding. Gianforte emphasizes, "This is because of our sales process," he says. "I hired 6 salespeople before I hired the first engineer. I had 30 salespeople before I hired someone for marketing. Sales are the lifeblood of a business, period. And what about financing? We raised about 27 million in 1999 and 2000. We had 6 million a year business and the VCs gave us $130 million valuation. On those terms, I would probably raise money again today. Gianforte recounts. So the full interview, the full case study is on our blog again. It's a wonderful story. Contrast that with my early experience. In the talk I gave at the Indian Institute of Management, Ahmedabad, I shared that I once drank the venture capital Kool-Aid, but you shouldn't. You see, I came of age as an entrepreneur in the 1990s, a time when venture capital was flowing freely. Quite mistakenly, I bought into the conventional wisdom of that time that venture capital is a mark of success for entrepreneurs. In the valley of 1998, it was the prevalent philosophy among entrepreneurs. I raised money early on and allowed the investors to bring on board an incompetent CEO. Then I got fired from my own company, was totally screwed on my equity share. I can tell you it was not a pleasant experience, and I certainly do not recommend it. Today, with the benefit of hindsight, let me emphasize a simple lesson. Ownership matters. Got that? Again, folks, feel free to ask questions. I'm basically going down my list of questions and answering them one by one. So the next one is also a bootstrapping question. When should you quit when bootstrapping with a paycheck? You know, I have a book on bootstrapping with a paycheck. In it, I offer a close look at the mode of entrepreneurship that has become a major trend. Entrepreneurs are starting companies in droves while still holding on to their full-time jobs. I give 2 interviews, one to the Chicago Tribune and the other to the Union Tribune of San Diego. And they ask me the same questions. If you're bootstrapping a startup with a paycheck, when is the right time to quit? This is what I told them. It's a personal choice. How can an entrepreneur know when it's time to make the leap to full-time self-employment? It's a personal choice that depends on your life circumstances, but at the minimum, you should definitely validate your business idea and determine whether it's going to generate money. Talk to customers and make sure they're going to buy. And keep in mind that most venture capitalists will not fund you until you're running your business full time. Before you go out to raise money, you're going to need to quit your day job. So those are the 2 things. So on the one end of the spectrum, you have to validate. On the other end of the spectrum, if you want to raise money, you're going to need to quit because investors won't fund you otherwise. Now, on the subject, there are 2 other relevant questions to consider. Should bootstrapping employees tell their bosses about their side businesses? A lot of people are actually disclosing, and the bosses are quite fine with it. In the tech industry, employers are encouraging employees to become more entrepreneurial. It's considered a plus, not a minus. We are working with companies, for example, Oracle. We worked with Oracle for 6 years where they're running corporate incubation programs on our platform. They're asking employees to become entrepreneurial. They call it intrapreneurship. Corporations are willing to incubate these ideas and give you resources and give money in exchange for a piece of the company, of course. Another question related, how can you do this without angering your employer? Now, if you're working for a tech company or a digital agency and building an e-commerce business on the side, if you tell your employer you're doing that, the employer's not going to care, as long as you don't encroach upon your day job. You should not encroach on your day job because then you're not going to fulfill your obligations to your employer. And that is unethical. Just to reinforce the point that you can, in many situations, should bootstrap your startup with a paycheck, I want you to point you to an entrepreneur, Girish Navani, CEO of eClinicalWorks, who has built a $1 billion unicorn company in this mode. We have lots of coverage of eClinical Works and Girish Navani's journey. The case studies is available on the blog. You're welcome to go check that out. The next question is, why is bootstrapping so important? Well, over the last decade or more, I've had the privilege of working with a large number of bootstrapped entrepreneurs. These include self-financed companies and also modestly capitalized startups that operate in a capital-efficient manner, applying the principles of bootstrapping. There is a bootstrapping course, my bootstrapping course on LinkedIn, that is about an hour-long course. You should do that. If this is a topic that interests you, you should go do that course. It's just an hour. It's a really fabulous course. It will really set the context on bootstrapping very, very nicely for you. For our Seed Capital series of podcasts and blog interviews, I've interviewed hundreds of investors, especially micro VCs and angels who are playing an important role in the early stage game. You may have read my piece, Bootstrapping to Exit, where I highlighted the importance of facilitating capital-efficient startups and smaller exits, including with small chunks of investment. This is a topic that we have also discussed at length at some of the earlier sessions here during these online rendezvous. In working through the current landscape of our industry, a few trends become evident. A large percentage of VCs are chasing unicorns, too much money chasing too few deals capable of delivering hypergrowth bids up valuations. Many death by overfunding tragedies have emerged. Entrepreneurs are reacting, as Erin Griffith points out in a New York Times article, more startups have an unfamiliar message for venture capitalists: get lost. My observation, having covered bootstrapping for a dozen plus years, is that the industry doesn't fully understand bootstrapping. No, bootstrapping and venture capital are not necessarily mutually exclusive. The savviest and most successful entrepreneurs have bootstrapped first, raised money later. VCs love to invest in bootstrap startups that have validated and de-risked their ventures before institutional capital is invested. There is nothing wrong with that approach, as long as entrepreneurs understand a few key principles. VCs love to come to the rescue of victory. Do not go to VCs as beggars, go as kings. Excess is not a requirement for success. Entrepreneurship equals customers plus revenues plus profits. Financing and exit are optional. Hypergrowth is not a natural phenomenon, but VCs demand it. I do not believe entrepreneurs should ask VCs to get lost. I'm going to write a weekly series, I'm writing a weekly series on LinkedIn in which I debunk many of these myths that exist on the topic. If you're interested in following this topic much more closely and much more deeply, you can subscribe to the Best of Bootstrapping series that I'm writing on LinkedIn. You just go to Best of Bootstrapping and subscribe, and you will get notifications when each episode is published. And there are lots of prior episodes that you can also look at that are very, very, apropos, very pertinent, important topics that you need to understand if you want to understand the startup, bootstrapping, and venture capital nuances of our industry. Okay. I will do one last question, and then I will explain to you how to use 1 million by 1 million roundtables, and that would be it. So maybe another 5-10 minutes. The last question, is how can you play this low probability game of fundraising intelligently? Let me start with a quote from Mark Andreessen, and I quote, "At our venture capital firm, we only invest in a sort of Silicon Valley style tech. We see 3,000 inbound deals a year, And those are inbound and coming through our referral network. So those are sort of pre-qualified. We can do maybe 15 or 20 investments out of the 3,000 a year. So I like to say our day job is crushing entrepreneurs' hopes and dreams. Our main skill is saying no and getting people to not hate us. I run 1 Million by 1 Million, a global virtual accelerator for startups. 2020 is our 10th year of supporting entrepreneurs. Thousands upon thousands of entrepreneurs have approached us for help with their funding at a stage where their chances of getting funding is zero. We can't help them. Regardless of how powerful our investor connections are, we can't help a startup get funding before they become fundable. It pains me to see how many entrepreneurs have no idea what makes a startup fundable. You've often heard me say that over 99% of the entrepreneurs who seek financing are rejected. Some statistics: Y Combinator rejects 97.15%, AngelList rejects 98.8%, and recent Horowitz 99.3%. If you get rejected by accelerators, angels, or VCs and they don't tell you why, you need to understand the objections and the analysis that led them to their decision. Most good investors take the time to explain. Also, there are some fairly standard reasons why entrepreneurs get rejected by investors. So my humble advice to all entrepreneurs is please learn to assess your own probability of getting funded. There's a 3-minute video on our YouTube channel, which is called Probability of Fundraising. Please go and watch it. Very, very helpful piece to watch. You want introductions to angels and VCs? A fundable, validated business is a must. A fundable business with warm introductions is the fastest way to get funded. We can provide the warm introductions, but you have to get to fundability. You have to get to validation. And sadly, less than 1% of the businesses are fundable. What that means is more than 99% of the businesses waste their energy on pitching their unfundable business to investors. Hugely unproductive, hugely unhealthy. There is a very good reason why savvy entrepreneurs have been using the bootstrap first, raise money later strategy. Generation after generation of entrepreneurs have used bootstrapping to get to a fundable stage so they can call the shots at the negotiation table with their potential investors. I have nothing against funding. I have scores of friends who are investors and I respect their work, but my heart belongs to entrepreneurs who are capable of doing the heavy lifting of extensive validation. That's where we can add the most value, and that's why we are in the trenches with those true entrepreneurs every day. Okay, that brings us to our last question. How can I get feedback from you on my venture? Well, 1 Million by 1 Million offers free online mentoring roundtables for entrepreneurs looking to discuss positioning, financing, and all other aspects of building a startup venture. Up to 5 entrepreneurs who register to pitch on our free public roundtable page on the blog, on the website, will be able to present their businesses. They will get straightforward feedback, advice on next steps, and answers to questions from me, as well as potentially some of my frequent guests who are CEOs and VCs. You need to register to attend, to listen, learn, and join in on the conversations via live chat. And everyone who registers will receive the recording by email the next day. The upcoming roundtables this Thursday is one. So basically each Thursday in February at 8 a.m. Pacific, we have a roundtable. You can go and register to pitch or attend. Those who register to pitch will also receive instructions on the preparation required, including a roundtable slides pitch template. We also recommend using the 1M by 1M self-assessment tool to help prepare the pitch. This is available on our blog for free, the self-assessment tool. Several entrepreneurs interested in pitching have first expanded their knowledge of the essential components of building a startup by joining our monthly 1M by 1M basic program and going through the 1M by 1M curriculum. By pitching after learning the curriculum, entrepreneurs get much more takeaway value from their interactions with me during the public roundtables. Please note, we work exclusively with IT and IT-enabled services businesses, and these roundtables are public forums. The recordings of all sessions are shared online, and entrepreneurs who pitch will receive media exposure through the roundtable recap column, which is posted on our blog and elsewhere. Members-only private roundtables are offered as part of the premium program. If you have concerns about privacy, you should join the premium program and not pitch at the public roundtables. So that is all for today. I hope you found the session useful, and I'm going to continue to dialogue with you in the comments. If you have put in comments and have not heard from me yet, I will stay on and answer your questions shortly. So I'm not signing off yet. I'm going to sign off from the video so that I can look at your comments. This is Sramana Mitra, founder of 1 Million by 1 Million, saying goodbye for now, and we will see you soon, either at the next public roundtable on Thursday or next week's online rendezvous. See you soon. We also, by the way, have a rendezvous, in-person rendezvous in Menlo Park at Cafe Boroni at 5 p.m. Pacific on Wednesday this week. That's tomorrow. See you soon. See you again. I hope you make lots of progress. Bye-bye, everybody. Thanks for coming today.